So you've got Trust and Will doing Super Bowl commercials, right, to the mass public using AI inside of their technology. Wealth.com, who Diana and I both have a connection to. Also using generative AI in kind of the creation of documents and all of those things. And so that's happened really, really quickly also, where you're going to see, especially in the advisory world and consumer world, a mass adoption of the estate planning technology over the next, I'll say, 24 months. For people in the space, we feel like it's already there, but I mean, it's not even 1% yet of the adoption that it will be in that space. Like, it's going to be massive and transformative. That one's coming.
You are tuned in to the Money Script Podcast. Today we will share strategies to help you grow your financial literacy and improve your money script. I'll be back with some important announcements. Until then, enjoy the show.
Welcome to the Money Script Podcast. It's your host, Yohance Harrison. I hope all of you are well out there in the world. Today, I am joined by one of my favorite people on the planet. I told you all this is going to be a season of me getting to interview some of the people I respect in this industry, and Jamie Hopkins has been on the list for a long time. We finally figured out he is a busy guy, so busy, very busy guy. Jamie is the author of multiple books on financial planning, financial literacy. He is the president of FinServe Foundation, which I had the joy of doing some recent, what do we call that? When you work with people for free? Mentorship. There you go, that part. Did a little mentorshipping with them. That was fun. I really enjoyed that. He's also a professor at Creighton University. He is the chief wealth officer of Bryn Mawr Trust. Ladies and gentlemen, Jamie. Thanks for joining me, Jamie.
Nice to see you, Hans. And I know, we finally got on the recording. We pass each other's ways sometimes, but actually on here is nice too.
Yeah, we get to cross each other in the hallways of all the wonderful conferences that we go to, or you'll be presenting in one room and I'm presenting in the other. And I'm like, I missed yours. And you're like, I missed yours. I'm like, all right, well, we'll find a way to see each other someday. And here we are. We did it. Yeah. So Jamie, as I mentioned to you before we started the show, last week we had a conversation with Diana Cabrices, who I'm sure you know and respect as well. And we were talking about AI and some of the products that are out there that are helping advisors do a better job, and what we think is coming in the future to continue to help advisors. And at the Money Script Podcast, we have a very broad audience for this season. Some of them are advisors because of all the speaking I've been doing in our community. And some of them are, of course, clients and prospective clients, but generally it's people that want to learn how to grow their financial literacy. They come to listen to some tips, some tools, learn a little bit about the industry, and hopefully it sparks more questions so that they can go seek the answers to those questions. So as someone that's been in the space for many years, by the way, still top 40 under 40 for 2 more months. Is that right?
A couple months here.
Hopefully by the time this comes out, you're still 40 under 40. But again, as an author of multiple books in the space, I'm just curious because I believe your last book was in 2018. Is that right?
No, actually, I had one 2 years ago. So I guess
2022. Okay. So So the AI revolution was really just coming to a head at that point. So I'm curious, just what are you seeing in the landscape from financial planning, from financial literacy, that AI can enhance for the average individual that's just, maybe trying to do it on their own, trying to figure out their 401k, things of that nature? How do you see AI playing a role in that process?
Yeah, I mean, it's one of the big questions everybody has is, where does AI land, and how much does it disrupt? How much does it supplement? How much does it change? And, I think one of the things we probably know about AI is all of our assumptions about it are going to be wrong.
Yeah.
So, but look, AI is being used out there today. This is not something anymore. You go back a decade ago, we were talking about AI, but there really wasn't any functional AI systems out there at that point. And it really kind of came into the hands of people. It felt like almost overnight. Now, that's not true, but it did feel like that for a lot of people, where we had ChatGPT I felt like was the kickoff point of all this. Now there was other stuff out there, but that kind of came out to people's hands with OpenAI, and people were using it. It wasn't costing anything, and all of a sudden you're like, wow, this is real. And TikTok, social media, people started using it for videos and graphics and articles, and it took off very fast. When you think about like an adoption speed of anything, OpenAI's ChatGPT is really the fastest adopted platform or technology we've ever seen in our lives, right? I think it went from like 0 to 100 million users, right, in like 2.5, 3 months, something crazy like that. I'm wrong on those numbers. You can ask ChatGPT what they actually were, but the point was, up until that time, it was the fastest.
It was fast. Yeah, it was fast.
Yes, that's the important part. Don't cite my numbers, but the adoption speed was astronomical. We've never seen anything like that, and so it really did feel like it showed up overnight. Now, when you go to some of the technologies that are out there, they've layered in whether open or closed AI actually for a bit of time. IBM, Microsoft, Google, they've all been experimenting with closed AI systems for a while now. But then all of a sudden we've learned about an open AI, and anyone can put information and it can learn more broadly. So there are both of those out there. In our space, you're starting to see some of this technology be marketed. I'll start with one area, is the estate planning realm of the financial world.
Wow. Yeah, that part of that's Diana and I talked about that. That market has exploded, and rightfully so. It was so overdue for a disruptor.
It was. So you've got Trust and Will doing Super Bowl commercials, right, to the mass public using AI inside of their technology. Wealth.com, who Diana and I both have a connection to, also using generative AI in kind of the creation of documents and all of those things. And so that's happened really, really quickly also, where you're going to see, especially in the advisory world and consumer world, a mass adoption of the estate planning technology over the next, I'll say, 24 months. For people in the space, we feel like it's already there, but I mean, it's not even 1% yet of the adoption that it will be in that space. Like, it's going to be massive and transformative. That one's coming. Now, even in that space, that has to be supplemented by an attorney. Like, we still need attorneys to review the docs and execute them and work through them. So it's not kind of full end to end yet, but it's cutting out a lot of it. And so the back end of these systems have created networks of attorneys that can help actually then execute, deliver, move forward the documents. So it's sped it out. It's made it cheaper. It's expanding it. And that's a great thing, because most Americans do not have up-to-date estate plans, wills, trusts, power of attorneys in place. And we need them. In the complicated world of assets today and transfer of assets, it's much needed. It's probably as much needed as any time really in the last 200 years that we actually need this type of planning in place. Family dynamics are more complex than ever before too. You still have a lot of states, stepchildren don't qualify as your children unless, so like the general rules don't qualify that. And you think about how many people have stepchildren in today's world, it's massive, aren't legally your children under most
they're not
states.
legal lawful children, as the documents say.
So
if you don't adopt them, they're not your children,
right? So you need this type of planning out there for those situations, and that's just fundamentally different than it was 40 years ago. I mean, today having stepchildren is probably almost more the norm than not, right? Like it's very, very common.
I made one of those.
Yeah. See, I've got 3 stepsisters, so like I grew up in this too, but I mean, it's normal today, and so our planning and has to catch up where the laws have not caught up. Now, go a little bit further outside of that. I think the one use that people are seeing it most today, outside of like generative writing, is going to be in the note-taking system world, right? So you've got a bunch of technology that's popped up, can hop in your Zoom meetings, your Teams meetings, anything else, and do recordings, right? It'll record it. It can do a summary for you. It can cut out video clips. It can do where there's a Q&A and take the Q&A and actually cut that out for itself. And the next phase of that, so that's kind of like help us record notes. I don't have to take notes anymore, record it, and even do a summary.
I don't know what to do with my hands in meetings anymore. Shout out to Jump and Pulse. I don't.
Yeah. And so the interesting part about this space is that there's a bunch that came on the market really quickly, right? Like I used
True.
one in FinServe. We use Read.ai as the one in FinServe Foundation to record our meetings and transcribe them. And it kicks out a reminder email to everybody in the meeting once the meeting's recorded and done. Because I used to sit there and draft them up. Now, in all fairness, the ones I draft up are still better. It still misses context and things.
Because you're Jamie. You're
but
real.
I think it's anybody, but it's not perfect yet. And in an ideal space, I think you still go back in and rewrite them. But also, this is a fully volunteer nonprofit. So if we can take our meetings in terms of automated emails that are 80% as good, that's actually a great use of time. So we just use that now. We don't go back in and edit them. I think the first 3 or 4 I did, and then I was still spending a lot of time doing that. The next really cool part about this is a lot of those read and note-taking AIs are trying to figure out how do you take this and then create workflows after it that can automate workflows. So if we said in this interview, like, hey, make sure I follow up with an email with an introduction to Tyrone, who we both know, right? All of a sudden, it already knows that. It generates it. It might not execute it, but we go back to our email after we're done this, and the email is drafted to do the intro between the two of us to Tyrone Ross. Like, that's super cool. So that is really where the next iteration of those are going. And there's a handful out there that are working on that and in beta groups actually being tested in financial services too. So you think about a client, you say you want to rebalance or make a trade, it starts populating that into your workflows after the meeting. It won't execute and push it, but that is a really, really cool feature that will be on our doorsteps within the next 12 months.
It's already in my doorstep. So I'm testing it both in Pulse 360 and in Jump. And it's incredible. Like I still have to, my assistant still reviews it and makes sure it's starting the right workflow. But actually Pulse will start the workflow. But I had to, when I tested though, I had to turn it off. Because if I just said the word workflow, even if the workflow is already started, it didn't know, hey, that workflow is already going. We're just talking about it, and it would start a new one. So it was a little aggressive. But yeah, no, that is, I would say less than 12 months. I would say first, second quarter, most advisory firms, especially independents, will have access to one of those tools and at a very low cost. Very low. Like the price of this stuff. I mean, it's kind of like Zoom. I think Zoom was one of the first that really did that. Well, they saw how ubiquitous their product could be and they priced it appropriately. I mean, I might be paying 8 cents per Zoom meeting or something like that. Which, when you think about the rent of an office, like, I mean, 8 cents per client session is good. Zoom could tell me that they're going to double the price tomorrow and I wouldn't bat an eye. My AI systems, I know you're listening. You could double your price tomorrow. I wouldn't bat an eye. It's that incredible of a service.
Eventually the AI will learn exactly how much you're willing to pay for it.
Exactly.
Right. Like it'll know, right? Like it's four times as much. That's one benefit maybe of like traditional SaaS software where you're just like, this is a great deal. So, that one's exciting, right? It's in beta with a lot of people. It's being tested out there. To that point, though, I would probably second where you have seen is I do think the whether you want to call it aggressive or just the checks and balances on having it start without you, I think that we're further away from that. There's a lot of complexity there. And this will lead to one of my AI hot takes as I go too. Which is, we are going to have people, I'll do it now, but I just did this on a call because people were talking and everybody's super positive about AI, and I am too. But I will also bring up the flip side. And my flip side is, look, like there is this other side of the coin, which I think is true, although I lean in I love AI where it's going to go, is we will have an anti-AI pushback in our culture at some point. We pretty much have gotten it with everything else. Like there's always an anti-technology adoption subculture that occurs. There is just change subcultures that occur that push back against change. I kind of use this example because I think it's probably the most relevant for today where we're sitting, but like made in the USA. The reality is it is more efficient to make most products from a global economic standpoint less costly, more efficient, better products by outsourcing most manufacturing from the US to other countries that have lower cost of workers is essentially it. Sometimes it's also because the cost of goods and how far things need to be shipped, but there's efficiencies in a macroeconomic world. The reality, though, is the last, I'll say, decade in the United States, we have had a pushback against outsourcing as much manufacturing as we do. And part of that is jobs, but part of it is people want to buy something stamped with made in the USA. And so we do have companies that their distinguisher is not that they're a better product, not that they're cheaper, but they're made in the USA. And so it's not about efficiency. It's about being anti-outsourced goods, right? Is essentially what it is. That's a version of it. So you could actually see companies that basically go like this. Oh, all the other advisory firms, they're giving you robot advice. We're still giving you human to human advice. Okay, that's going to sell with somebody. I don't believe that's the majority of the market, but it's going to sell with a portion of the market.
I do your financial plan on a legal pad. I don't use Excel. I still use a HP 12C calculator when calculating your retirement.
Yeah, mine's in this drawer somewhere too. I got my calculator around. I don't know that the batteries still work, but it's here.
I use mine. It stays on my desk because anytime I need to do a math problem that my brain just can't figure out, mortgage calculation, future value. I'm just, my thumbs are used to doing them.
We know how to use it. But we'll get some pushback there. And then my next part about that is the pushback, it doesn't really exist today. The pushback today is I don't believe that this is going to be as good as it's going to be. That's the holdup today. It's like, it's okay. It can't replace what I do. The pushback will occur after we have an automated system that fails because of AI, to that point of structuring workflows. And all of a sudden you have a Merrill Lynch that, something happens in the market, right? And AMC starts to tank and it says, oh man, AMC's tanking. Well, why is it tanking? Because in the morning, there was a press release that they're filing for Chapter 11, right? And it just automates it and buys everything they can possibly buy. And all these clients get auto allocated into some stock that's essentially going to zero. But the algorithm didn't check it, right? The AI didn't see it. And all of a sudden you have a lot of very angry people who then file a lawsuit. And then all of a sudden there's an anti-AI movement, but it could be something worse than that, right? Like it could be a water system that accidentally empties a dam, right? Like we're going to get something like that. I hope it's more just in a buy world, not a like emptying a dam on a town, but like But the AI is being used heavily, right? Why we're reopening nuclear plants is because the AI is going to be able to operate them at an efficiency level that we didn't think we could get back to with nuclear facilities. But, it's probably less likely there because they're going to build in a lot of redundancies. But it will happen somewhere. And then we'll have a subculture of like, hey, this is why we need people, not AI.
Well, isn't that really just we've seen that happen already several times? Like you said earlier, more in a closed AI system where we had these flash crashes that would happen inside of either a sector or in a country specific currency or even in a stock because Merrill, Smith, Barney, one of those big guys, Goldman Sachs, they forgot to turn the lights off. And we weren't supposed to sell all that stuff, but the system that they built, an AI, was just reading the triggers and saying, I'm supposed to sell, and it kept selling, and it's like, oops, we sold 1 million shares we weren't supposed to. So that I think it'll be a little bit different when that's happening on a broader scope. I mean, the amount of people that get affected, because with Goldman Sachs, it just happened in their account and the other 10 people that happen to be trading it that day. But if it is like you said, an AMC or Kroger or one of those big companies, and now hundreds of thousands, if not millions of investors are affected by that, then I could see that. Wow. I hadn't thought about that.
The other thing is that mostly today, the closed systems, they talk about them more as algorithms failed.
True. Right? Yes. They don't call them AIs. They call them algorithms. They don't call them
AI yet. So the blame on AI hasn't really hit there. And you will have mistakes And sometimes it's not even the size. Sometimes it's just the news cycle finds one and they run with it for whatever reason. And that's the one that people know about. Because like I work now in the banking world. And look, banks have always failed, just like any other company. They go out of business every once in a while. Now, it's a much more regulated and actually safer environment than any other business you can think of. But when a bank fails, sometimes it's in the news and they go under. And then sometimes it's national news, even if it was like a very known thing that's been in the works for 8 years. And I've just noticed that, right? That like some just catch on and some don't. Obviously, SVB, First Republic were big. They impacted a lot of people. So those were like good national news ones. But sometimes there's ones like in state level community ones and they go under. And sometimes there's no news about them. And at other times it's like, oh, another bank failed. And you're like, well, yeah, but like, there's like 12,000 of them. When you think about how many companies, if you have 12,000 companies, like a couple go out of business every year. Like that's like normal.
It's normal. Yeah.
But sometimes it just hits the news cycle. I mean, even today, I thought a very funny AI thing was, the X or, formerly Twitter AI. I don't know if you saw this today, but it listed Elon Musk as the biggest spreader of misinformation from his own AI.
From his own AI. Oh, that's sweet.
That's just funny, right? Like,
well, who are you going to believe, Jamie?
I know.
Elon or his product?
Or his
Come
product.
on.
Like one of the
he can catch a spaceship with chopsticks. There's also that.
Yeah. So like,
wow.
But that's just funny, right? Like
that's hilarious.
It's just funny. I don't know of anything else to say besides that. Like
that's funny.
You build this AI because he's always like, hey, it's the best out there. And then literally today it listed him as the #1 spreader of misinformation, which is like,
wow,
pretty funny. I got a chuckle out of that because I was like, this is one of those things, right? Like, as him, you don't think it's going to like turn on you. And I think that was the headline. Like
the only thing that could make that funnier if one of his robots had said that, like if the robot had said it versus it just being printed on a screen. Yeah. If a robot that would have made it even more classy. That would be the beginning of the us versus the machines. Oh yeah, that would be it right there. They would become public enemy #1.
Yeah.
Oh, that's the enemy within. All right. Okay. Moving on. On that,
I'm gonna have to delete this whole segment now.
I know, right? Oh, AI is going to pick this up too in a couple of years. So, Jamie, you spoke a lot about how just some of the different ways that AI is impacting financial services, and even some of the risk that could come from that, not only for the advisors, for the firms, but also the end clients. What about the large population of consumers, of investors that don't yet have a relationship with a financial advisor? How do you feel AI is going to impact their ability to find good retirement advice and the tools that are being integrated into some of the systems for the John Q. Public?
Yeah. This is a tough space to see how it's actually going to kind of land out. And my thoughts on it probably vary. Even in a conversation, somebody makes a good point and I go, okay, that's a good point. Maybe it goes like that. And part of the reason I have so much hesitation in this space on what it's actually going to look like is, I thought robo advice was actually going to be bigger than it is.
I did too. Yeah.
And honestly, the funny part about robo advice is like the companies that hopped in that space just look like traditional financial service firms today. Like I like Betterment. Betterment looks as close to any other financial service firm that you can, drum up on the street today. Right. Like, yep. I mean, they grew, but then they all stalled. Like, I mean, their exponential growth did not keep occurring. Right. Like they plateaued for a bit in there, and they're a good company. They've got some cool stuff. But they're not leaps and head above anybody now. I mean, even regular advisory firms, right? AI on the back end and allocation software and direct indexing pretty much pulled advisors up to be able to do anything that any of the robo platform allocators could do internally for a client too, right? So they weren't as big as I thought they were going to be. And now that technology kind of exists within most financial advisory firms, not everybody offers it as a do-it-yourself standalone service, but in essence, they could if they really wanted to spend like 4 months to spin up a portal and just offer it and allocate. It's really table stakes in that regard now. So where is AI going to land for individuals? I mean, I do think the looking at portfolios to find inefficiencies in allocations, that's the one I really like today. Is just like you see people go out on the retirement account, and this is pretty common. They'll pick 4 different target date funds, and right, it's just a very common thing, and there's no need for that. It doesn't cause a lot of harm, honestly, either. But like, it's just waste. Like, it's not useful. You have, the point of a target date fund is you have one. You really shouldn't allocate to other stuff if you're going to go target date route. Funny enough, too, Vanguard has this. People actually pick target date funds that end in 0 over the ones that end in 5.
What?
Oh, yeah.
I didn't know that. That's hilarious.
Yeah. So like, they just didn't really, I mean, nobody really understands why. You just call that a finding, that people prefer target date funds that end in 2040 or 2050. They don't pick the 2045, even if that is their actual retirement date, right? Like,
that's awesome.
It doesn't matter. Like, we just like the one that ends in 0. So like, that's a good area for, AI to come in and be like, hey, you're supposed to retire in 2045. Like, why are you picking the 2050? Like, target date fund. So there's stuff like that. And then especially if you have, if you can aggregate them together, or you are doing that through a platform, it could also look and say, like, you've got stuff in Vanguard and you got stuff over here. And honestly, you're almost investing in factors that are anti each other across different things, right? Like, you're going really, really deep into growth over here, and then over here, you're all value. And like, okay, like, why are you doing value and growth split evenly? Like, is the point to diversify? Like, okay, but maybe it says, like, if you are trying to be a growth investor, like, half your stuff is in value. And you're like, oh, well, I didn't want to do that, right? So I think that is going to be good. It can definitely review fees very easily today, and internal fees, which people have never been good at looking at. So that's a benefit too. So you kind of think about that allocation, portfolio analysis, and creating a more efficient one for your same kind of level of stated return or goal. That's going to be a great one. And that'll roll out in the traditional platforms relatively soon too. So like, inside of a Fidelity, inside of a Schwab, inside of like any of these custody platforms, and even the new ones coming up. So, that's an interesting thing. How fast do they move versus some of the other services? Well, yet to be seen, but that'll be at everyone's fingertips relatively soon.
Do you back to the age-based portfolio, the target date portfolios? Has it ever been a concern to you that a target date portfolio may underperform what the client needs to reach their retirement goal?
Yeah. So target date fund conversation is a totally different thing. At almost any individual level, target date funds are probably not the best investment option. But from a public policy standpoint, in mass, target date funds actually work really well. So it's kind of one of those things that's like, you kind of have to dissect like an individual versus a policy. From a policy perspective, target date funds actually outperform individual investors in mass, right? Like, they do. But when you get to any one investor, they probably should not be in exactly what the target date says, right? It should be a little bit different. And that's kind of the balance on target dates. So like, if you care about knowing what your investments are, or if you like have real goals, or you've done the work, or you have an advisor, you probably won't be in a target date fund. However, if you've done none of those things, nor do you want to pay attention to this, nor do you want to like figure out what your goals are yet, it's a perfectly fine vehicle for the masses. I'm not super opposed to it there, but yeah, and there are other issues with target date funds too. They're not all created equally, and they don't have a good I'll say, wind down period strategy. And they're all different. Some will actually increase slightly the allocations again back towards the market. Some go to 0. Some don't change any of the allocations once it gets down to its drawdown. And that part of target date funds is actually the part I have the bigger problem with, because you do see people stay in them post the 2030 time period, and then they flatline. And that's likely fairly harmful for somebody.
Yeah.
But leading up to it, if you marry it with your distribution time period, it takes you on an okay trajectory towards where you need to go. But most research actually shows that a rising equity glide path in retirement, post-retirement, is a more effective retirement income strategy to maintain that portfolio. So Michael Kitcey's Wade Fowle posted on rising equity glide paths. I believe Dr. David Blanchett has too. And that notion is counter to how most people think, that you should be more and more conservative as you move through retirement. But actually, what most of the research suggests is you should start retirement relatively low in your asset allocation percentages. So you're actually better off starting retirement, say, 30% equities, 70% bonds, spending down the bond portion over time into the point where like you're maybe 70-30 the other way.
Yeah.
That actually outperforms on average a 50-50 stock bond portfolio that you keep level, and a declining one that starts at 70 and goes to 30.
Sure.
Equities.
I agree. Yeah, I agree.
Yeah. That part is not super surprising, because you're spending down your high growth assets over a long term. I think the part that surprised people was that a rising equity glide path was superior to a steady 50-50 glide path, which most people conceptually, I don't think makes sense, right? Like it seems like a steady one would not be beat by one that's lower equities when it starts than when you go through retirement.
Yeah, I do believe that with the target dates, though, there's a psychological factor of having a number when they retire. I find that clients will get attached to, okay, even if they work with me or any other financial advisor, they find out, all right, I need 3 million to retire. So the idea of the target date, or even if they're using the tools on their own, on Empower, Fidelity, the target date kind of gets them to that 3 million number. And if the target date does what it's supposed to do, the likelihood of a flash crash, recession, bear market will have a lesser impact on the psychological ability of them to retire. And yeah, even if their portfolio went down by, they had 3 million, went down by 10%, does that mean they shouldn't retire and need to work 2 more years? No. But psychologically, they may feel that way. And I noticed that happened in 2008. That happened in 2022. 2020, it kind of recovered, but my clients that were retiring in 2022, if they weren't in a target date fund and mostly fixed, they were like, well, wait, am I still going to be able to retire? The account's down by 15%.
Yeah.
Did you write your letter? Send your letter in. And that's it. Don't worry. We're going to be okay. It'll recover. So, well, Jamie, I appreciate you taking some time with us on the Money Script podcast and having some enlightening conversations around AI and how it's going to impact not only the financial services community as a whole, the interaction that we have with prospects, with clients, but also what some individuals are going to start to see on their own and things they should be looking for. So if you have a 401k or a 403b or any of those type of accounts, spend some time, log in onto your account, see what tools they have. A lot of them have some planners that you can use to try to figure out, okay, how much do you need to contribute? And they also will ask you to tell them other assets that you have. So that will help in those calculations, or else it's going to say, oh, you're never going to retire. Well, because it doesn't know you have an old 401k somewhere else. But start digging into those tools a little bit and see what sort of recommendations that they're giving you. I encourage you to take some of the workshops. A lot of 401k plans have workshops that you can take so you can learn more about your plan. Whether the Roth is an option, what the matching plans are, and also asset allocation, the difference between the different plans. And I encourage all of you, if you have a target date plan, does it end in 0? Does it? Okay. And if it does, is that the right choice? Now, I was born in 80. So my target date might have a 0 at the end if I plan on having retirement at 60 or 50 or whatever the number. But if the year you were born doesn't end in 0 and you're thinking I'm going to retire at 65, check and see. Check on that. Jamie, you mentioned something that somehow I missed and AI missed when we did your little pre-work here. You mentioned earlier that there's a book that you just did 2 years ago. So what was the book after? What was it?
Yeah,
It was a
rewirement.
requirement. That's it. So that
Rewirement.
was the latest one?
No, so rewirement's
Okay.
all about changing the way we think about retirement income planning and the behavioral factors. Then we did Find Your Freedom, and I wrote that in 2022. Well, I think it published at the end of 2022, and that one is really it's kind of like a financial planning journey, but it's more about the emotional side and like not so much the math side of the financial planning. So like starting with aspirations and our values and who we are, and really building a plan outside of that. Even to the stuff like I've got a whole chapter on your what I call accidental community. So all the people around you today, that most of them you didn't pick in your life. It's an interesting thing. Like, you think about, you've picked some communities, maybe you picked a sports team, but then you show up later in life and you look around, most of the people around you didn't pick. Like you went to work and other people hired them, and like you live in an area, you didn't pick your neighbors, they moved in later, and like you live in this what I call accidental community. And I think people need to be more purposeful as they move through life of making sure that they are in the right community for them, not just their accidental community. So like I've got a whole chapter about that one in there. So it's a little bit different than like a traditional financial planning, here's how to save money and like compound interest. And then funny enough, I just signed a contract with Harriman House for my next book this last week. So there will be a new one that is mostly done. It's about 80% done. It will publish in the beginning of February of 2026, which seems like a long time, but it's only like 14 months or something like that. It'll be like hitting the shelf. So it's like really not that far out. Yeah. And so that is something I do like writing, but yeah, when we wrote the other one, we didn't have ChatGPT editing, and I will probably use some ChatGPT editing in this book. But yeah, we'll see. I do still have a human editor that is part of the book process, but it'll be fun. And yeah, I will drop one other thing here. We don't have time to discuss it, but I do also have a hot take that I think. We talked about Zoom and what they've been able to do. I do think that there is a chance that AI, one of the big impacts will be the increase of in-person meetings again. So I think AI.
That's a hot take, Jamie. Hold on. Wow. Yeah, we'll have to talk about that another time.
Well, because we're not going to be able to trust video. Video is going to become untrustworthy relatively soon. Video and audio recordings on a computer. We will not know if it's you, me, a bot, and we are dangerously close to that, right? And right, if you look at the big custodians, they've all been hacked with audio, so that biometric audio backup has failed, right? The technology has passed the systems that protect it, and we're not there yet on video. Like we couldn't truly fake the two of us here today for a whole podcast, but it's getting close, right? And I think that's going to cause business meetings and other things, backup, all those things to start to occur in person.
Wow. Hot take, Jamie. I appreciate it. Once again, we appreciate you joining us on the Money Script podcast. Do someone a favor, just one person. Send them this link and say, hey, I thought of you as I was listening to this. Because you did. You thought of someone. Actually, you know what? You thought of someone in your accidental community. So why don't you reach out to one of those accidents and say, hey, it wasn't an accident. It was on purpose. And send them a link to the show. We'll see you next time on the Money Script podcast. Thank you. Thank you. Thank you. Thank
you. I'm back. Wasn't that a great show? I hope you learned something. I know I did. Now, before you go trying anything you heard today, remember, it is not intended to be specific tax or legal advice. If you need that, go see a CPA or an attorney. If you would like any complimentary consultation with a knowledgeable advisor, visit moneyscript.com and schedule a 15-minute consultation. Want Yohance to come speak at your next event? Go to the Money Script website for that too. Of course, if you're watching on YouTube, make sure to like, comment, subscribe, and click the bell for notifications. Money Script Wealth Management is a registered financial advisory service in multiple states. Want to learn more? Get the full disclosure on our website, moneyscript.com.